Well, the big story this evening, Standard & Poor's has given its verdict on India. It's affirmed a BBB minus A3 rating as well as a stable outlook. There is expectedly disappointment within the Indian government. They were hoping that post-Moody's, S&P would also have given in an upgrade. But for more on this, let's go across to Ravi Bhatia of S&P. Ravi, appreciate you joining us here on the show. As I pointed out, we just heard from the government, from the Economic Affairs Secretary, saying that S&P has chosen to be cautious this time around in comparison to the Moody's upgrade that we've seen come in. Would you agree with that assessment? And why has S&P, to quote the Economic Affairs Secretary, chosen to be cautious on India?
Well, I mean, we've affirmed the ratings. It's an investment-grade rating. The outlook is stable. You know, the growth story is good, but we've seen a bit of wobbles at the moment with a couple of quarters of slower growth. The reform momentum has actually been good. I mean, there's been a whole host of reforms pushed through. But again, there have been some sort of teething problems on the reforms as well. That's with the GST and with the demonetization and even the bankruptcy law. So, you know, there's been a couple of quarters of weaker growth, although in the medium term, we think the outlook, you know, the growth story is strong. And then, of course, there's the fiscal deficit remains sizable, because if you consolidate with the center and the states, it's still a big number. And also the debt stocks remain really quite high. So, and GDP per capita in India, despite the very strong growth, is very low, and actually the lowest amongst all the peers at this level of BBB minus.
So if I could put to you the government's argument, Ravi,
we have maintained the stable outlook.
You've maintained the stable outlook. But if I could present you the government's argument, and for instance, let's pick up on the point of low per capita, which, as you point out in your report, is amongst the lowest in comparison to India's peers. But the government's argument is that rating agencies traditionally have been unfair to developing markets like India, and it takes time for per capita to grow. And this factor seems to weigh and constrain India's rating, which the government believes is somewhat unfair. How do you respond to that?
Well, I mean, India has a number of strengths. I mean, as we mentioned in the report, the external story is really looking quite strong these days. Current account deficits are low. That's partially helped by the recent years of lower oil prices. And also the reserve story is really good, with over 6 months of import cover. So on the external accounts, you know, we look across the board at various factors: institutional, economic, GDP per capita, monetary, fiscal, and external. And India has definitely got some strengths. External is very strong. Fiscal is weak. So it's a combination of factors, and our criteria are comparative across you know, all countries. So we use the same framework for all countries, really.
Let me talk about what you say could merit an upward revision. You say that upward pressure on the ratings could build if the government's reforms markedly improve its net general government fiscal outturns, so reduce the level of net general government debt. Upward pressure could also build if India's external accounts strengthen significantly. Just on the issue of fiscal consolidation, the government so far saying that they intend to stick to the glide path that has been articulated. They hope to be able to maintain that 3.2% fiscal deficit target. We're also in the midst of, or in the process of, trying to roll out a new Fiscal Responsibility Management Act. Whether that comes up in this session of Parliament or in the next session of Parliament is still a question mark. How are you viewing the efforts on fiscal consolidation and the glide map that's been articulated by the government?
Yeah, well, I mean, definitely, you know, they've taken measures, and the deficits at the federal level have been coming down. But remember, we have to always add the deficits at the state level. We look at deficits, fiscal deficits on a consolidated basis. That is adding the, or what we call general government basis, which is adding the states and the center together. And still, when we combine the two, the deficits are high, and the debt stock is quite high. Yes, you know, and at the state level, things have not been going that well, you could say. They've been going better at the center. There's been spending at the state level. So on a consolidated basis, it doesn't quite look so good. But the debt stocks remain high. I mean, partly mitigating that is that India issues most of its debt domestically, so there isn't really an exchange rate risk there. And also, as you say, they're on this glide path, so hopefully the deficits in terms of stocks will come down, and you know, we'll be watching that.
Okay, you know, let me talk to you about the medium-term outlook for growth, which you say remains favorable, and it will continue to be based on private consumption as well as public infrastructure investment. I wanted to get your thoughts on the bank restructuring plan that the government has unveiled. You know, we're still not clear on how the accounting of the recapitalization bonds will be done. You believe that the recap plan will help revive investment, but what's your sort of take on the recapitalization plan and what it could do as far as growth is concerned, and how it could be accounted for as well, and possible impact on the fisc?
Yeah, I mean, broadly the plan you know, looks good, really. The banks have been suffering. There has been this issue of NPLs. They've needed the recap to reach the Basel III, to meet the Basel III requirements. So this plan is broadly good. And also lending has been weak, so hopefully this should help that. Although, I mean, we have concerns also on the demand side that lending is really hasn't been, it's not only been a supply side and credit supply issue, it's also been a weakness on the demand side. But broadly, we're expecting an improvement. I mean, there is a question on how it's going to be financed, but in terms of overall as a percentage of GDP, the numbers are not that high. I mean, we consolidate. We look at it and on a consolidated basis, in terms of percentage of GDP, they're not that high. So it's not a major concern as a contingent liability right now. But so broadly good. I mean, we're watching it to see how it pans out.
Okay, let me then talk to you about the outlook as far as GDP growth is concerned, because you do say that India's GDP growth rate is amongst the fastest of all investment-grade sovereigns, and you expect real GDP to average 7.6% over 2017 to 2020. What could be the downside risks as far as growth itself is concerned? What would you be watchful of?
Well, I mean, yeah, I mean, certainly there are downside risks. We could see a weaker consumption. We could see the impact of higher oil prices going ahead. There are a number of risks. I mean, whether if the banking situation doesn't improve as we planned. And of course, in terms of risk to our rating specifically, I mean, we're watching the fiscal carefully and how that pans out. So there are a number of risks, and the question is also whether these sort of few quarters that we've seen of wobbly quarters at the moment of weakening growth, whether they are really just tied to the demonetization and the implementation of the GST, whether they're teething problems, or actually whether we're seeing a broad slowdown of the Indian economy. I mean, we think the medium-term prospects are good, and these are sort of, you know, broadly temporary. I mean, having said that, you know, we're not seeing the heady days of very strong growth of well above 8%. But still, you know, good figures going ahead in the medium term.
You know, let me put good figures in the medium term. But Ravi, let me again put to you the argument from the government that they believe that this case about India's debt, the way that whether it's Moody's or S&P look at it, is overstated and exaggerated. The government's argument is, look, we've never defaulted. You know, India has stuck to its commitments. India has never seen a case of a default, and hence their belief is that perhaps the fear that rating agencies highlight when it comes to government debt is overstated. How do you respond to that?
Well, first is the point that the rating is really high. I mean, is high. It's in investment grade, so we're not expecting a default at this level. It's nowhere close to where to the levels, say, in the single B, where we would consider, or triple C category, where we would consider a default. So, we agree with them that we don't really expect a default. Having said that, I mean, the debt stock still remains high. The track record has not really been that good on reducing fiscal deficits. I mean, if you look over the last 20 years, deficits have really averaged above, consolidated again, if you take states and center, which is the metric we look at, they've been above 8%. So now, as you say, this glide path is in motion. But the debt stocks are still high. So, but once they go down, we'll reassess and we'll look at things then.
Okay. Let me also then ask you about your outlook as far as public sector banks are concerned, because you say that they require a capital infusion of about $30 billion to take large haircuts on loans for viable stress projects. We're also in the midst of starting to see the stressed assets going through the NCLT process, with the ordinance coming in now as far as the bankruptcy code is concerned as well. How are you reading both those developments? One, recapitalization of banks by way of bonds, and also the need for the government to address the stressed assets through the bankruptcy code.
Yeah, well, both are positive measures. I mean, there's been questions, perhaps they could have been done earlier. But they're both basically good measures, and we do expect to see an improvement across the board. And this has been an issue. NPL levels have been high, and also recovery levels in India are low relative to other countries. It's definitely measures in the right direction. As I said earlier, I mean, the question is how much is on the supply side and how much is on the demand side, and whether there is a slackening on the demand side as well. But broadly, I mean, the banking reforms are good for the economy, and that's the way we're viewing them. But, our bank analysts can comment more on that.
Sure. Ravi, again, I come back to the comments that have come in from the government saying that S&P has always been slower off the block. How do you respond to that comment? And obviously, this is in the context of the fact that we've seen an upgrade coming in from Moody's. So this comment from the government is in that context. How would you respond to it?
Well, I mean, as I said at the beginning, I mean, we've assessed according to our criteria. There are positive aspects, like on the external and also the institutional framework in India, we consider quite good. And monetary policy, the framework has been good and has improved quite significantly. But having said that, and of course the growth numbers are strong. But having said that, GDP per capita is very low, the lowest amongst all its peers, and the fiscal story, despite the glide path, is still, is a work in progress. So it's a combination, and we've also seen these couple of quarters of wobbly growth. So we're looking at the story, but right now our assessment is the BBB minus with the stable outlook.
So, Ravi, in terms of future triggers for a possible upgrade, for a possible upward revision, any specific reforms that you would watch out for beyond, of course, looking at what happens to debt and what happens on fiscal deficit?
Well, I mean, we don't give policy advice. It's really, we're looking at the story. I mean, if the fiscal numbers were to improve, then that's something we would look at. The external story is good, but if that was to improve further, that's also something we would look at. And then there are the other aspects. If GDP per capita were to rise much more rapidly than we are forecasting, and move up, then that's something we would consider as well. So it's a combination of factors that we're looking at and we're considering. I mean, the biggest one is the fiscal story and, you know, on a consolidated level.
You know, just in terms of the fiscal deficit target of 3.2%, and the government says that a final call will be taken in December on whether they stick with 3.2% or there could be a deviation, albeit a minor one. If it were to be 3.5 or maybe a tad higher than that, that's not the expectation. But even if it were to be 3.5, you know, would that be a cause for concern for you?
Well, I mean, you know, we're looking at it over broadly. I mean, over our forecast period over a few years, and we also consider the track record. And as I said, it's consolidated, so we have to look at what happens at the state level as well, which you know, sometimes tends to be not the number that for example, the media picks up in India. They're largely always looking at the federal deficits alone. So it's a combination. Right. And when we look at that, you know, and also we look at really the debt stock as well. So the two together and how the trajectory is going on that. So that, you know, we're going to look at all those factors.
You know, you say that improvements in policy making continue to strengthen the prospects for India's economic and fiscal performance. In terms of the various measures that the government has undertaken, whether it's the improvements on the ease of doing business or it's moving towards a goods and services tax, you know, which are the areas that, that you believe has seen the most qualitative improvement?
Well, you know, there's no doubt there's been a bunch of reforms pushed through, and there's been fairly good reform momentum. It's broadly on the back of an already, you know, reforms done in previous years, and which has given the rise to this high growth trajectory that India's on. So you know, they're all broadly in the right direction. And there have been implementation issues and teething problems now, specifically around the GST. But then once it kicks in, I mean, it should help on the fiscal side, and it should also help create the internal market that was somewhat restricted in India in previous years because of octroi and other issues. So, you know, they're in the right direction, and the question is, will it be enough to maintain the growth story going ahead? And also, of course, as I've said, if there's more momentum on the fiscal story and containing that.
Well, Ravi, it's been an absolute pleasure. Many thanks for joining us here on CNBC-TV18 and taking us through why S&P has decided to, or the rationale behind S&P's decision to affirm its rating on India as well as its outlook, which is stable. Appreciate your time and thanks very much for joining us here on CNBC-TV18. Ravi Bhatia, Director, Sovereign and International Public Finance Ratings at Standard & Poor's, there on the rating action. Well, there's plenty more that we are going to take up here on CNBC-TV18 as we decode the impact of this decision. That and more when we return.